This video will be talking about the context in which the Meidner Plan was developed. Why the life of its core designer, Rudolf Meidner, a Swedish economist, extremely important not only to the plan with his namesake, but the whole Swedish economic order that it would have been applied within, is interesting enough to be a topic of at least a video. For the sake of focus, I will be glossing over that in favor of painting a bigger historical picture. Through this series, one of the main sources I'll be drawing from is the paper Socializing Capital, Looking Back at the Meidner Plan by Joe Guinan, which I will link in the description and is well worth a read on its own. In the immediate aftermath of World War II, Sweden, like most wartime economies, had recently exited a period of immense levels of state planning. They had ample experience with the fact that it was, in fact, possible and even effective to operate an economy with a large degree of central planning of goods and services, with goods being rationed and directed for the goals of the state, without the dependence of an economy dominated by privately owned firms operating in a free market. So, like in other countries, towards the end of the war, the Swedish left wing started developing plans for a peacetime planned economy. While this was never implemented, it does emphasize the fact that policymakers were convinced of the ability of the state to play a large, effective role in the economy. In the post-war era, Sweden had a booming economy, its neutrality during the war giving it an advantage similar to what the United States' distance from the conflict helped convey it into the post-war era. Namely, as they were not the target of bombing campaigns and ground warfare, their industry was intact to sell to those who had been. This had the consequence of limiting and to a degree extinguishing the urgency for the state to intervene in the planning side of the economy. In this boom environment, private capital was more than capable of creating the production and capital investment necessary not only for a growing economy, but an economy with low unemployment. However, in keeping with the trend around the Western world at the time, there was still an appetite for the creation of a welfare state, and in this case, particularly one tied to union activity. This led eventually to a strategy formalized by what is known as the Meidner model. This model was developed by Rudolf Meidner alongside Swedish economist Gösta Rehn of the Swedish Trade Union Confederation. This model had four overarching policy goals. Low inflation, keep prices stable to create a consistent economic environment. Full employment, encourage hiring and entrance into workplaces across sectors of the economy. High growth, being able to afford increasing standards of living and having an economy consistently worth investing in. Income equality, have an economy that maximizes fairness between sectors. In order to achieve these aims, Sweden built an expansive welfare state and a public sector capable of counteracting economic downturns by maintaining strong state spending. This also came with progressive taxation, having higher taxes for those with higher incomes and lower taxes for those with lower incomes. However, there is something critical to the implementation of the Meidner model that made it different from other welfare state systems. Swedish unions played a critical role in the economy, but it wasn't simply one of conflict. In 1938, Swedish labor unions, through its national organization, the Swedish Trade Union Confederation, came to an agreement with the Swedish Employers Association, the National Organization for Businesses, in which they agreed to negotiate in a manner that benefited both sides while minimizing social conflict. This meant unions strong enough to negotiate a position of increasing wages alongside economic growth and full employment. However, the consequence of this was price instability, inflation. Unions rationally pushed for higher wages, and businesses rationally raised prices to increase profits. This created a contradiction. The goals of the Meidner model included low inflation, and the traditional way to decrease inflation in this context would be to allow an increase in unemployment. Yet the Meidner model also aimed to ensure full employment. In order to achieve the aims of the model, two measures had to be taken to address inflation while still maintaining full employment, and simultaneously pursuing income equality and high growth. Unions accepted policies and changes in conditions that meant encouraging unprofitable firms to shut down or increase their productivity, decreasing inflation by increasing the amount of goods that money was chasing after. Also, unions had to organize and develop wage solidarity policies that ensured that low-wage workers would receive the bulk of the increase in wages, with high-wage workers receiving a cut-down in wage increases, therefore cutting down on inflation. While these changes seem as if they work well enough to achieve the goals of the Meidner model, income inequality did in fact decrease between low and high wage workers. a new problem presented itself. Measures to increase productivity of unprofitable sectors and measures to decrease the wage increases of those who worked in high-income sectors ultimately served to ensure that those who owned businesses were the primary beneficiaries of the increases in economic growth. This had consequences beyond simply increasing the incomes of those who owned capital. It ensured that the group of people who owned capital were a smaller and smaller portion of the population, a vast concentration of wealth. This threatened to undermine the welfare state model, as that concentrated wealth, as we're all familiar with, was economic power that could easily be converted into political power that could be used to perpetuate wealth, and therefore economic power, and therefore political power, and so on. It's important to emphasize that the wealth that threatened to undermine the social democracy was created by the social democracy itself. In fact, Swedish social democracy was unique in its ability to create this immense wealth concentration. IKEA's growth in the 1950s and 60s was boosted by being a primary provider of furnishing for homes as part of a state procurement program for social housing, a dynamic that might be familiar to those who are aware of how the military-industrial complex operates in the United States. Sweden had, relative to the size of its economy, twice as many Fortune 500 companies as the UK, and 4 times as many as Germany. This measures more than simply the amount of wealth being generated, but the fact that it was concentrated enough to allow multiple companies to slip into the upper tier of global company valuations from a country with a relatively small population. Even beyond the basic reality that wealth could easily be transformed into political power, there was a direct power emanating from shareholder control that could be exercised to directly control the direction of companies. Such a concentration meant that worker representation could not properly exploit the differing interests of shareholders in order to shape businesses towards the benefit of labor. So, now with these problems explained, one can understand the environment in which the Meidner Plan was conceived. In 1971, the Swedish Trade Union Confederation's Labor Congress commissioned a study for the purpose of finding a way to meet the social democratic goals that the previous reforms had embodied, while also addressing the emergent tension between achieving high growth rates and income equality, and secondarily, to address the problems of increasing wealth inequality. The team tasked with the study was led by Rudolf Meidner, Anna Hedborg, and Gunnar Fond. With their given objectives, they clarified 3 aims for their study. 1. Complement the wage policy based on the principle of solidarity. 2. Counteract the concentration of wealth which stems from industrial self-financing. 3. To increase the influence which employees have over the economic process. For the sake of clarity, I will elaborate further on each of these 3 aims. The first aim emphasizes the fact that whatever solution was to be proposed, it needed to complement the wage solidarity policy. This means that efforts needed to be made to build on top of the successes of the policy, which did manage to lower inequality between high wage earners and low wage earners. But it is more than possible that one could end up endorsing a system of worker ownership that actually locks in inequality between workers rather than minimize it. 2/3 of income inequality comes not from the differences between workers and management, but between, for example, those who work for Google and those who work for the firms that Google contracts out janitorial work. The second aim looks at curbing the wealth inequality that stems from industrial self-financing. There were firms with excessive profits enabled by various elements of the social democratic system. These profits would be reinvested into said businesses, ensuring their increased profitability, though naturally those gains would primarily benefit the owners of said businesses rather than the workers, especially since wage solidarity policies prevented the relevant unions from going out ahead of lower-income workers, as that would, of course, create income inequality and ultimately undermine the solidarity that empowered workers to stand together enough to demand anything from their employers at all. In pursuing low inflation, income equality, and full employment, you ended up creating an environment in which high growth led to rapid accumulation of capital. It seems from here obvious enough that the ultimate way to close the circle would be the transference of said capital into the hands of the workers. As for the third aim, increasing the influence of workers over the economy, is not directly tied to the objectives outlined by the Swedish Trade Union Confederations, but from a tertiary problem created by the 2 previous problems. Increased wealth concentration led to situations where a few shareholders, after cobbling together the right to vote by proxy for other shareholders, were capable of manipulating the direction of companies completely, leading to a powerful oligarchy having the control they needed to benefit themselves at the expense of the interests of the workers. Any solution would have to work to democratize the workplace to protect the gains that the workers had long fought for. These three aims were to be respected on top of respecting the goals of the Meidner model. As mentioned in the analysis of the second aim, it was obvious enough that the solution there would involve some form of worker ownership, addressing the system of private capital which had escaped with barely a scratch in the post-war reforms. Yet, as I covered in the analysis of the first aim, there is nothing inherent about worker ownership itself as a concept that prevented from violating the other aims and goals. What was needed was a plan that could successfully balance all of these complexities. Hence, the employee investment funds and the organizational infrastructure that was to be built around them, which I will go into detail on in the next video. To finish the video and better understand what the Meidner Plan would become, we ought to look at what it didn't become by looking at the solutions that were considered but ultimately decided against in the study. Firstly was the concept of branch funds. This was a proposal that had emerged a few times in Sweden before the commissioning of the study, and even concurrently with it. In summary, it was a plan centered around addressing the first aim delineated in this study, respecting the income equality promotion efforts of the wage solidarity policy. The idea here was that companies with high profitability would be instructed to pay into a fund that would be used to supplement the wages of workers in low profitability companies. There is more to it, but the core problem here is that this would be effectively a subsidy for inefficient businesses and practices, which would naturally promote inefficiency. The second suggested solution to deal with this increase in wealth inequality was to do something that should sound very familiar. This would be to simply increase the corporate tax rate. Now, this is definitely something that should be addressed in far more detail in another video and covering a context far broader than just 1970s Sweden, to the point I'm hesitant to go into depth as to why this was not the solution that the Meidner Plan came up with. So I'll directly quote Rudolf Meidner from his 1978 book, Employee Investment Funds, An Approach to Collective Capital Formation, and then work to explain that position. Quote, "The solution which we recommended does not therefore involve a severe and all-embracing increase in the corporation tax. What it does mean is that a tax policy which has encouraged investment and the consolidation of assets will in future not have the adverse distributive effects which it had undoubtedly had in the past. If we are to retain the ground rules of the present system of company taxation, this does, however, presuppose that the system has to be built into an arrangement which enables employees to share in the growth of assets, which is at once a prerequisite for and a consequence of the self-financing processes which is at work within business enterprises." End quote. Meidner here is making the point that 1. We don't want to hurt economic growth. 2. A higher corporate tax rate would hurt economic growth. 3. We can ensure workers benefit from asset growth without hurting economic growth. It is here where you might see my hesitancy in regards to this subject. However, as I'm already here, I might as well go a bit deeper into this on a side note. All three of these propositions have come under attack, particularly in recent times. This is despite the fact, in regards to the first proposition, left-wing thinkers right across the spectrum from liberal reformists like John Maynard Keynes to revolutionary socialists like Karl Marx agree that the development of productive forces is, in fact, a good thing. Of course, this is all a topic better served for a discussion in a completely different video, but is relevant enough here as a defense of one of these three propositions. The second proposition, that a higher corporate tax would hurt economic growth, is in this particular context true enough. In the quoted book, Meidner makes the point that there simply exist different types of profits. Quote, "Excess profits in the wage policy context, that of untapped potential or scope for pay increases, and excess profits as more a temporary or cyclical phenomenon." End quote. There are times when a corporation's profits are reinvested in equipment and expansion, and then there are times where it is simply pocketed by shareholders. It is a complicated thing to have a corporate tax that can successfully differentiate the reinvestment from the pocketing, and even making it progressive, higher taxes and higher profits, wouldn't properly account for that. This is by no means saying that a corporate tax is always bad, particularly if it's compensating for spending on something that is more beneficial than just simple corporate reinvestment. but it isn't an effective tool for wealth redistribution. The third proposition, that we can have workers benefit from increased economic growth without harming it, is an argument which is viewed with a measure of suspicion on the left because it seems to be, word for word, the mantra of the centrist third-way turn of social democratic or left parties across the Western world. The key difference here is that the Meidner Plan did not intend to do this simply by clearing away the debris left by capitalism, as at some point the effort that needs to go into clearing up the debris ends up getting in the way of the profit maximization of private property, and when that happens, it's the debris clearing that gives way, not the private property. Instead, the plan here would be to go directly after corporate ownership, to get workers inside of the machine rather than out of its way. By talking about what the Meidner Plan and its wage earner funds were not intended to do. It was not a plan to make funds for each individual company that workers worked at. It was believed that doing so would hurt solidarity between workers at different companies, i.e. they would compete unnecessarily with each other. It was not a plan to tackle wealth inequality by simply taxing capital at a higher rate. Dealing with general wealth inequality was determined to be outside the scope of the development of the Meidner Plan, whose primary focus was dealing with the inequality caused by businesses accumulating unequal wealth through financing their own growth. It was also not a plan to give workers shares that could be individually withdrawn and converted into cash. That would allow the workers' share of ownership to be decreased or eliminated, in addition to forcing firms to pay out in cash what would be better reinvested in growth. Now, the reason I went back into describing what the funds were not intended to be is because each aforementioned description helps break down the explanation of the Meidner Plan into three distinct parts. In the first part, I explain the intended structure of these wage earner funds. The second part explains how these funds would have been filled with shares, and the third part explains how the fund was intended to be used. So starting with the structure, let's begin with the left side of this diagram here, and how it pertains to the right half of the diagram. The left side of the diagram covers more that's related to the next two sections of my explanation of the Meidner Plan, but we'll come back to that. First, the system has a method, which will be explained later in the video, in which the shares of companies with more than 50 employees, though different drafts of the plan had different minimums, would be issued to unions that represent the workers in a given workplace. It's important to make it clear that the plan described here was intended to specifically work within the context of high union density as existed then and now in Sweden. The unions then would pass those shares up to a single centrally administered clearing fund, which then decides how that value represented in those shares would be spent back downward. Importantly, as shown in this chart, these unions are also responsible for electing those that run the clearing fund. A key feature, as emphasized in the previous video, is that this plan was intended to increase democratization in the economy. Therefore, it was decided that even though this clearing fund would receive shares from the unions, it would not be expected to administer the value of the shares and associated dividends and the voting power associated with owning those shares directly, even though its board members would be chosen by unions. This is where the right half of the diagram comes in. During the development of the Meidner Plan, it was understood that it made sense to have intermediate funds that managed the value and dividends of shares at a level above individual workplaces and unions, but below that of the central clearing fund. The main question was whether or not those intermediate funds would have been regional, i.e. split up by location, or sector, split up by industry. Ultimately, it was decided that the final proposal would recommend that those mid-level funds would be split up by sector. The reason for this was, to summarize, that the questions of industrial management would ultimately best be left up to those who knew specifically about that industry, rather than leave things to be managed by largely arbitrary geographic areas. Next, we look at how the board members of these intermediate sector funds would be selected. As shown in the diagram, just as with the clearing fund, the board members would be selected by unions. But unlike the clearing fund, there is another group labeled in the diagram as the community, which would also be electing board members. This here is where the Meidner Plan involves a recognition that the workers that are in workplaces which do not send up shares into the fund system, because, say, they work in a business with fewer than 50 employees, or they work for the government, should also have a say. It was not assumed that political policy should be pursued directly through these funds via these representatives, but that this connection would help coordinate between the funds and the policies of governments. It should also be mentioned that while unions would be choosing the board members operating these sector funds, it would be in two different groups with equal representation. One group would be made out of unions representing workers within that given industrial sector, and the other group representing all those other unions who represent workers within the wage earner fund who were not in that sector. That would help ensure that those sector funds would not be operating in the sectional interest of their industry alone, and this would have been further augmented by ensuring that the board members represented the non-wage earner fund public would get to be a swing vote within those sector funds. It should be noted, however, that the idea was that at the start of these wage earner funds, the primary concern would have been managing the monetary value of the funds themselves, rather than concerning them so much with the operation of the companies that those funds' shares represented. Nonetheless, upon those funds gaining a large enough share in companies, those funds would have to pivot towards how best to manage those companies and eventually industries, not simply as workers, but as owners. This includes how to organize the appointments of the directors on the boards of individual companies upon gaining enough shares to practically exercise that right. As shown in the diagram, both the unions within the given company and the sector funds themselves would share responsibility for appointing board members within companies. With the general structure of the funds explained, we move next on to how those funds would grow to own shares in the first place. I had said earlier that the wage earner funds were not intended to tackle wealth inequality in general. It was intended to tackle wealth inequality that came from industrial self-financing, i.e., companies feeding their growth with their own profitability. Here we'll zoom out of specifically talking about the Meidner Plan to say that all successful companies do this, but those companies that have had the most blatantly massive effects on wealth generation do this the most. Perhaps the most famous example is Amazon, a company that for years operated at a loss, precisely so they could reinvest in the continued growth of the company and ultimately the value of its shares. It is by this process that Jeff Bezos, CEO, founder, and single largest, including institutional investors, shareholder of Amazon, is on track to be a trillionaire within the decade at Amazon's current rate of growth. Put most succinctly, the Meidner Plan was not so much a plan to stop the mechanism of self-financing that leads to successful companies seeing a spectacular increase in value, but to put that spectacular increase in value into the hands of workers collectively. To end this aside is why I'm more supportive of wealth fund proposals than anti-monopoly proposals. But detailing that is for another video. To directly return to the topic at hand, the wage earner funds were intended to harness self-financing on behalf of workers and were not intended to allow those shares to be diluted and turned into cash, but mostly reinvested in continued growth of the fund. The Meidner Plan called for an issuing of shares representing 20% of the profit of affected companies to be placed into the wage earner fund system. Profit in this case would have been determined by the increase in the value of the assets of the company from the start of to the end of the year. Now, there are a whole host of potential loopholes and ways to counteract them. However, I will not bog down the video with explaining those, nor the complications that arise from, say, imposing this plan on a company who's foreign to the nation that's implementing this plan like this. I can say that it was substantially covered within the plan itself, and for the most part are issues that tax law has to work to address anyway. What does need to be said, however, is that these shares would be acquired based purely off of profitability within the implementing country. For example, in the case of Sweden, Swedish companies with foreign subsidiaries would see the shares would be valued based on 20% of the profits of operations within Sweden, and foreign companies operating within Sweden, the same would apply. It would just be the 20% of the profits of the value of those assets within Sweden. Additionally, the value of those issued shares would be calculated before rather than after taxes, which means taxes on these corporations would decrease proportionally to the percentage of the firm owned by the wage earner funds. This actually benefits a corporation's capacity for growth, as it will be explained later in the section that covers how the wage earner funds were intended to use the value associated with share ownership. It is difficult to immediately picture what this rate of share acquisition would look like in terms of how quickly the wage earner funds would grow to hold a majority of the shares within the company at a given rate of profit. Thankfully, this diagram here is rather useful. At 5% a year asset growth, it would take around 75 years to pass 50%. At 10%, it would take around 35 years. At 15%, it would take around 25 years. I suggest doing your own research as to what the yearly rates of asset growth look like for the largest corporations in the world to see how that would compare. Now, for the last of the three sections of the core explanation, let's move on to the uses of the value in the funds. As mentioned before, this was not a plan to give workers shares that would be withdrawn and converted into cash. That would be allowing the workers' portion of ownership to be decreased or eliminated, in addition to forcing firms to pay out in cash what would be better reinvested in growth. To start explaining what these funds were to be used for, we can return to the diagram that outlines the structure of the wage earner fund system. On the left side of the diagram, we see resources leave from the clearing fund and go towards four boxes, representing education, research, expertise, and information that are further relayed towards the sector funds, unions, and small workplaces. You'll notice again, to emphasize this, that among those options, none is a direct transfer of cash to workers. One of the potential uses of the value associated with the fund, and that value would include dividends paid to the fund, would be spending it towards purchasing additional shares. However, we need to illustrate that the funds would be used to benefit general economic growth. For example, resources would go towards workplaces that would be too small to be included in the wage earner fund system, perhaps as informed by community representatives within the system. Resources would also, of course, go to unions and the sector funds for lower-level planning. However, it's important to emphasize what is meant by resources, more than just listing off those four categories. The idea was to not allow a situation where wage earner funds would be used to pick up slack in investment that would, in other cases, come from private sources, but only it would be in addition to that in ways decided within the wage earner fund system. This is not as simple as saying that X amount of resources would go into Y, as the specifics would have to be decided by the context because it would be a democratic process that this would occur in. For example, presumably in a situation where the fund system owns a majority of a company, there would be less of a reason to worry about taking over a majority of the reinvestment, particularly since a higher rate of profitability would also mean moving even more quickly towards total ownership of that company. All of this is meant to be flexible and democratically decided. The Meidner Plan was mostly about proposing a framework of a system that would be democratically manipulated to meet challenges as they came up. However, some things can be said about each category and why investment there would be important. The plan mentioned that the wage earner fund led research in business and political economy would be important, as while methods of research are more or less objective, what should be researched and to what end is subjective. A research dominated by the wealthy private sector is carried out for the ends of the wealthy private sector. So collective worker-led research ought to be carried out so that its results might closer meet collective worker ends. It is this logic that goes behind putting resources behind education, expertise, and the dissemination of information, as the sources of funding for all those things helps determine the character of what actually is produced by that investment. With the structure, growth, and usage of the Meidner Fund explained, we can move on to the conclusion. The Meidner Plan's wage earner fund system was intended to reinforce a Swedish social democratic system that guaranteed low unemployment, low inflation, and high income equality and high growth by dealing with the tremendous growth in wealth inequality that was, in a sense, a direct result of the successes of the social democratic system operating within its limitations. But before this video concludes, two more things have to be said that will be relevant for future videos. Firstly, it is notable that the Meidner Plan, in its task of addressing wealth inequality, did not concern itself so much with taking resources from the wealthy to pay workers. What it sought to do primarily was take resources from the wealthy for the purpose of fueling economic growth that would be increasingly owned by workers. To the extent that the lives of workers would be improved on a day-to-day basis, it would be mostly due to the additional economic productivity caused by the investment in growth. This is in contrast to a lot of modern social wealth fund proposals, which would essentially be used to fund a basic income. This is not a critique of either model, but an important differentiation. Additionally, it should be made abundantly clear that the Meidner Plan was never successfully implemented as described here. In fact, political controversy over this plan played a role in the Swedish Social Democratic Party not being in government between 1976 and 1982. And then when they came back to power, a severely watered-down employee fund system was proposed instead, and that was abolished when the Social Democrats lost power again in 1991. All that is a topic for a series of videos, likely not limited to the Meidner Plan. However, I can say one thing that is relevant to that. which is relevant to why I began this series over a year ago. Since I started this series, particularly within the last 9 months or so before this video came out, it had become brutally obvious that our economic system cannot keep going on like it has been. But at the same time, the people demanding change are mostly spinning their wheels, proposing mismatched policies that aren't enough, won't work anymore, never worked, and or don't lead anywhere. But anyway, the Meidner Plan is unique in that it was a tangible, practical plan to transcend capitalism that did not require some grand, almost mythical paradigm shift or a miraculous reawakening that completely changed how people saw the world around them. To finish editorializing, I mostly find myself observing proposals and plans for progressive change that are held together mostly by magical thinking. The purpose of this channel, of which this video is a part of fulfilling, is pushing against that tendency, not simply by tearing things down, but bringing things up. That concludes my video. Please like, share, subscribe, and comment.